And on today's show, how qualified plans and Social Security income are correlated. Part 4 of this week's series on end-of-the-year tax planning for 2014 with top producers Mike Kilbourn, CLU CHFC, and Rob Odell, CFP. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to InsMark, Life Specs, and Backroom Technician. Let's get down to business. Well, welcome Rob, Mike, to the show, day 4. Wow, our mind is flooded, right? But it's good educational experience. And today we're talking about some areas where our advisors are all over this, whether it's qualified ERISA plans like 401k, 403b. I think we're familiar to a lot of that. And I want to kind of walk through that because we have some new numbers coming up here in 2015. I've noticed that we're getting a little bump, but not much.
Right.
I have to say, I'm kind of surprised. I thought we'd get a little bit higher. Talk about indexing to inflation.
Yeah.
Give me a little bit more to contribute. But, I noticed, I wonder how many Americans actually, I'm looking at this year, at the end of the year, 17,500. If you're in a qualified plan doing a 401k with your employer, how many people really are maximizing 17,500?
The higher income earners.
Yeah, the higher, right.
Right.
And especially if you're matching, but the match usually doesn't go that high. So I'm wondering, but walk me through, these are deductions. And by the way, a unique thing about this now, I can take the deduction now. I may not have to worry about funding some of these, not all of them, till April 15th.
Right. Well, you want to make sure if you're going to set up the plan, it's set up before 12/31, and then you can fund it sometime in 2015 and get the tax benefit for 2014.
Okay, walk us through your and by the way, this is Rob's this map. What do you got? What's your?
It's called mind mapping.
Your mind mapping.
Yep.
I really like it. It kind of gives me a. This is not linear. I'm so used to it.
It's great for us non-linears, aka ADD guys.
Perfect.
Yeah, it's great that way. Well, the main types of plans that are available, employer provided, 401k, 403b, 457, profit sharing options, and sometimes they have Roth options. These are the two big ones, and they often have various options that go with them.
Well, when I'm looking at these options, I want to remind that our people that are over 50, the catch-up is still online.
Yes.
Correct.
So that's kind of another extra money. Do you see a lot of clients taking advantage of that? Once you're post 50, and if they have that kind of money, are they spending it? Are they saving it?
I don't see it.
I see it. I have baby boomers are a client. They're affluent. They make good money. Their kids are already educated, and now they're taking advantage of catching up their retirement savings because some of them took a break when they're educating their kids a few years earlier.
Is that going to bump for 2015, or is it going to stay around that number?
It's 5,000. Okay. But what goes up goes from 17,500 to 18,000 for the 401k employer election.
Now, when we're down here, tell me about your 52,000. I love that deduction. What is that all about? Is that a deduction or just deferral?
It's how much they can deduct, which is tax deferred at that point in time. So the maximum, if you have a one person or a solo 401k or a small company 401k, they can deduct up to 52,000, of which the 18,000 is a part of. So they can put away. So if you have a high income earner who's self-employed, making $400,000 or $500,000 a year, they can deduct 52,000 this year, 53,000 next year.
And is that only in the 401k?
The 401k.
No. Now, can you add on things to a 401k like a cash balance plan on that, or no?
Certainly you can.
In addition to that,
you can do that. Absolutely. So you can put away some serious money there. Now, there's some implications to that, but there's some serious money you can put away with various types of plans.
Now, when we're talking to 403b and 457 clients, that's kind of a whole different animal, and the numbers are relatively the same. But how do you approach a group that has these ideas, and you want to be able to bring them into a deduction? Hey, there's deductions to be had here. This is what you need to look at.
Right. Well, often the people who provide the 403bs provide the education. In fact, the employers want it of the nonprofits, even the for-profits. It's required that they come in and they have some type of education for their employees in how much they should be contributing, deducting if there's a match available.
Now, I notice you have a catch-up provision. Is that just for this group then?
Just for that group, which is significantly less than what the 401k people.
I'm so surprised how the IRS hasn't thought that cleanly through. All right, so these are our deductions. This is what we really have in qualified, and most
employer
of this is
provided.
Now, talk to me a little bit about the Roth. Is that worth doing?
It depends. So it really depends on what the person's income now will be, what will projected to be in the future.
Write-offs?
Yeah, write-offs that they have. And so right now, Roth IRAs were put in the law in 1997. Tax Act brought the Roth IRA. It's a tax-free IRA, so all deferral happens tax-free. Not subject to required minimum distributions, which is big for someone who wants to be able to pass something on to the next generation.
Right.
In fact, Mike often says that Roth IRAs are the best asset to leave behind.
Absolutely, because if you leave it behind, there's no tax. Your heirs now they're forced to take it out over required minimum distributions. Your heirs are, not you, and so they won't have to pay a tax though, and they'll take it out. We tell them take it out as using those.
Now I'm looking at these contributory. Now none of this is deductible.
Well, there's two flavors. None of it's deductible, after-tax money. There's two flavors of Roth IRAs. You have the contributory, which is some eligibility restrictions for people in high income may not qualify for that. But there's a way to get around that. And then you have conversion. And this is something that someone can take an IRA, convert it, they pay tax in the year of conversion, and then it becomes a Roth IRA going forward.
Now, before I get back, I want to make sure I heard this, get around it.
Sure.
You know, that just, you kind of slipped by.
Let's take Bill and Melinda Gates. He's a high income earner, I think, at least he was in his time. He would not qualify for a contributory Roth IRA. However, he could contribute to a non-deductible IRA, which he does not receive an income tax deduction, and then convert to Roth.
So he's not getting the deduction.
Right.
He's getting the deferral only. And when he comes out, it's still, he'd have to convert it, pay the tax on whatever.
Well, the thing about it, he's funding with after-tax money. So if he puts $5,000 in, there's no income tax on it. So it's just kind of a little Texas two-stepper, as we call it.
But it's the growth that he's trying to
get tax-free.
And that's pretty huge. What about conversions? You know, there's a lot of schools of thought on the web. I've noticed that people that are into serious, what they call bracket bumping, where they're filling lower, like 10 and 15%, the lower brackets, they want to use those brackets to convert. Do you see the math working in that regard?
Yeah, up to 25%, I think it works. And again, it goes, each individual is unique, their tax return is, but we try to fill brackets, whether by realizing gain or converting to Roth.
That's where the planners should look at all the numbers to make sure that it works for the client. But when it does work, it works really nicely, converting to a Roth. Actually, Rob and I worked together on he helped me plan my conversion to Roth, and I converted my entire IRA to a Roth. But the good news was we had the so-called divot, or what you call it?
You can recharacterize.
Recharacterize it. Not
Mulligan.
Mulligan.
We're not golfers, so we don't know that.
So I had my mulligan, and I did actually, so we divided it up in several different types of accounts, and we actually sent some back to become an IRA again. We had a whole year to look at this thing. And then we recharacterized it back to a Roth.
I must say, there are games to be played here. Well, no doubt about it. We come back from the break. We're going to now shift a little bit and look at Social Security and how all this actually correlates to our Social Security income and its taxability. We'll be right back. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. Of course, I'm with Rob Odell and Mike Kilbourn. We're talking about Social Security, and to me, after looking at the Social Security provisional income test, I have to say it seems like all this income is correlated, and it really makes an impactful difference for our seniors.
Absolutely.
Walk me through the mechanics of this, because I think this is an eye-opener.
Right, it is. Especially when you do income tax planning and you do the projections here and you start tweaking around with this, you see what happens on how much they pay tax on their Social Security benefits. So if we go to the basics, you have a single filer versus married couple. So for a single person, the first $25,000, if they have income income under $25,000, 100% of their Social Security benefit is tax-free. If the income is between $25,000 and $34,000, it's 50% taxable, and over $34,000, it's 85% taxable.
Now just to make sure I'm understanding. So when I look into 50% of the income is now exposed to ordinary income tax.
Correct.
Okay, and then when I get past this threshold, income over $34,000, and it doesn't retro, it's the next block up,
Correct.
right?
Correct.
So that's exposed to 85% of it is exposed to whatever my tax bracket is at the ordinary income tax rate.
That is correct. Now, figuring out the income for and what's called combined income for married, or the income for this test, is they take 100% of your muni tax-exempt interest, which is not a part of adjusted gross income, but is a part of this calculation. 1/2 of your Social Security benefits equals your combined income.
So, if I just heard you right, most of my clients that I know are buying municipal holdings for the tax advantage of, most of the time, tax-free. But that income now is going over to Social Security and causing an ordinary income taxable event.
Well, for your Social Security benefits, not your muni bond interest, but for the...
But just that it's occurring, so everything's correlated. So yes, I get it free here, but now it's counted as income for my Social Security test, and now my exposure could be, once I cross that 34,000 line, that's a chunk of change.
It's like they give it to you and then they take it away. That's when I start thinking about the whole Social Security thing. It's like, well, just turn the check back in the way They take 85%.
Well, walk me through a few of the strategies here. You got some places to play here.
Right.
Walk
so
me through
if you
that.
have someone who's under the 25% bracket, a married couple or single, and they have muni bonds, probably not the best decision for them because it's hurting their Social Security benefit. So one of the things that Mike has done very successfully, and I've worked with on several clients, is where he will do a single premium immediate annuity to replace the muni bonds and then have a life insurance policy when the individual dies or the couple dies, second to die, however they situate it, is tax-free replacement for the heirs. And we've compared that to muni bond strategies, and often for certain people, this is a much better advantage because of the Social Security benefits that they get. They pay less tax on Social Security.
And they get the safety of the muni bond. In fact, probably in some sense it's safer. Depends on how you look at this.
Now, Mike, I want to ask you about this. Now, you know, the exclusion ratio, are you guys talking about a lifetime income SPIA, or are you talking about a time certain? Period
Lifetime.
certain?
Lifetime.
Okay, so if I'm lifetime, I have an exclusion. I have this blended. I have a two-part portion here. But
Right.
then how powerful is getting my basis back on a non-qualified SPIA like this in regards to Social Security?
Well, you go.
It's huge because it could be 90, 95% of the income you're getting from that SPIA is tax-free return of principal, not muni bond income.
Correct.
That's huge.
And that goes till your life expectancy, and then after that, your SPIA might be 100%. The SPIA income might be 100%.
Then it's exposed to ordinary income tax like
Right,
it always is.
right. You get your principal back.
Now, when you talk about life insurance tax-free, we know that the death benefit is, but I've noticed some planners now are getting a little skillful about using the actual withdrawals to basis and policy loans to gain on TAMRA-compliant contracts
Absolutely.
to generate tax-free income during while they're taking Social Security out to keep that from injuring their Social Security benefits or getting it taxed.
Right.
Makes good sense.
So do
Great
you see much of this in your
Absolutely.
practice?
I don't see much of it. Most of my clients are in retirement or at retirement, and so they're a little higher tax bracket. So I don't see it as much as Rob.
I see it a little bit more, and I deal with a little younger demographic, so people in the high incomes getting ready for Social Security, that's part of the plan that we have.
I've noticed that we've become much more sensitive and awake to the RMD issue. Seems like everybody's now awake to this is a management issue. This is a tax issue. We really got to figure this out, and we're going to get into this in another episode. But you know, this new QLAC is going to really help this new qualified longevity annuity contract, where you can push almost 25% not to exceed 125 grand
Correct.
a piece, mom and dad, right?
Into contracts, yeah.
And you push it out, and that's because managing. Do you manage as an RIA? Do you manage to that issue, RMDs?
Oh, absolutely we do. In fact, sometimes before 70 and a half, we start managing when they turn 59 and a half, if they have a large IRA and we know they're going to get out to 70 and a half, and it's going to be a big number, you might want to start filling up some of those brackets by taking money out or converting to Roth now.
Well, that's all the time we have for today. Before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just hop out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you tomorrow.